Okay, so thanks again, Simon. Always a pleasure to present for you. And guys, hope you're all well. Hope you've had a great day with all the other speakers that have been presenting. So just to give you a brief background of myself, I'm a long-term trend trader. So hopefully you'll see something a little bit different in this presentation. I've been trading since 2007. It took me about 4 years before I could effectively be trading full-time. I know that's a goal for many people. It took me 4 years to achieve that. At the time when I was trading, I was working as a photographer and an English teacher. So the advantage to trend trading is really that you can adapt trend trading around your lifestyle. I'm sure a lot of you guys that are tuning in are either employed or are business owners, maybe married, you've got children. Effectively, everyone's got a lifestyle. And then when you turn to the markets to generate a second income or to leverage your money, your savings, your salary, which you should be doing, you certainly don't want to just be leaving it in a bank or even giving your money away to an institution. You know, this is something that's very achievable. But as private traders, we often get derailed in terms of what is the best way forward. And you really want to think slow and steady, and you want to think long term, and you want to think of a way that you can trade without compromising on time and without compromising on money. And that is why long-term trading is really far more beneficial than short-term trading. There's just, beyond the growth, it's the lifestyle that trend trading will eventually afford you. So hopefully you get a real good glimpse into the way I do my analysis day to day, some of the trades that I've been in since last year, so I still have these trades open, and also where I can see the market effectively going towards the end of the year. Now, as a trend trader, I don't focus on just one market. I'm not an FX trader, I am a trend trader. So first and foremost, what I want you all to appreciate is that I keep an eye out on all the markets. If I just grab a little bit of space here, I'm going to just see if this works actually. Okay, and I'm using my mouse, so I doubt this is going to be very neat, but you know, no, I don't think it's working. Where's the pen? Okay, no, I was hoping to draw, but it doesn't seem to allow me with the mouse that I am. But ultimately, what I have are three markets: foreign exchange, stocks, and commodities. Now, within stocks, I also look at UK stocks, as I'm based here in London, but of course US stocks as well. So Forex, UK stocks, US stocks, and commodities, they're the main markets that I focus on. Now, as a trend trader, what I want to do is go to where the trends are, where the money is ultimately. If you're just focused on foreign exchange 365 days of the year, you're often going to miss out on better opportunities elsewhere. So the first bit of advice that I would give to you guys out there is expand your portfolio. Don't limit yourself to the euro dollar or the majors or even just foreign exchange. Branch out. Look for opportunities in other markets. Go to where the trends are. The Aussie dollar, US dollar is a perfect example. If you actually have a look, this is the monthly time frame. So the setup that I have, guys, this is a typical chart setup of mine. So I have the monthly chart at the top, I have the weekly chart bottom left, I have the daily chart bottom right. So I'm looking at all three time frames, and what I'm looking to do is develop an edge using these three time frames. Now, of course, if I'm looking to hold positions for weeks, months, even potentially longer, then I need the time frames to allow me to do that. If I'm trading on a 1 hour time frame or a 4 hour time frame, the chances are that I'm going to be in and out on the same day, if not a few days later. With the larger time frames, I can hold positions for as long as those trends are in play. So so this is a typical chart setup of mine. On the left is my watch list. Now what you can see is the foreign exchange market, but I have a list for US stocks, I have a list for UK stocks, I have a list for commodities, and that will all be here on the left hand side. And I simply click on the top here and I'll jump between whatever lists I've created. Here you can just see indices and stocks, but I have other lists, UK stocks, commodities, etc. The monthly time frame is very useful. Why? Because it really gives us an overall idea of what the market is doing. So you can see very clearly whether the market is in trend or in consolidation. So if you have a look, If you take it from this area here around 0.95 down to 0.70, that's a move of around 2,500 pips. That is what I would call a trend. After every trend, the market consolidates. So the Aussie dollar US dollar is a good example of how at the moment it's just consolidating. And that is pretty much what currencies have been doing for a very, very long time. Euro dollar, the last time I traded the euro dollar was when the euro dollar fell from 1.4 to 1.1. So that's around 3,000 pips. Of course, I didn't enter bang in on 1.4 and I didn't exit bang on 1.1. It was in the middle where I entered around 1.35 and then exited on the pullback, the correction around here. Very good profit made. But you can see since then, the euro dollar really has just been in this consolidation. It has been in this move to the upside. It's now at 1.2 where it's finding resistance. If it breaks this 1.2, then I'll start looking for long opportunities. The whole idea of trend trading is allowing a trend to establish itself and then getting into an established trend. This is far easier than trying to predict tops and bottoms, which is what a lot of private traders tend to do. So the monthly chart, as mentioned, is very useful. Why? Because it tells you instantly what kind of market conditions you're dealing with. It also gives you very clear areas of support and resistance. So you can see, looking at this chart, where the clear areas of support and resistance are. You've got resistance here, resistance here, resistance here, support at 1.2, strong level of support, support down here around 1.05. So the monthly chart gives you a very clear idea of support and resistance. And it's on the monthly time frame that I look for support and resistance. I don't go down to 4-hour and 1-hour time frames to draw support and resistance because that's all noise. In addition, the monthly chart is useful because if the history displays good trends, then there is a good chance going forward that we're going to be involved in good trends. Remember, trading is all about probabilities. It's about stacking the odds in our favor as much as possible. So if the past displays good trends, then the future is likely to display good trends. Of course, market structure can change, environments can change, but that only happens when the market dictates. Up until that point, we want to try and stack the odds in our favor as much as possible. So that's the monthly chart. Key levels of support and resistance, 1. Secondly, it tells me about the history. And the third point is it tells me what kind of market conditions I'm dealing with currently, whether we're in trend or in consolidation. So looking at foreign exchange, it hasn't been very appealing. It is starting to look appealing, but for a very long period of time, it's just been range bound. This is the euro dollar. This goes back to March 2015, where it's just been consolidating. And it's in these environments where I stand aside. Now, while foreign exchange has been consolidating, I've been heavily exposed to stocks, both US stocks and UK stocks. So one of the most profitable stocks that I've been in since May of last year is NVIDIA. And I entered NVIDIA at $40 when it broke the all-time high. This is going back to May of last year. And you can see that it is now just under $220. So NVIDIA has been a very, very, very good stock. If you have a single stock like this in your portfolio and you hold that stock and then add new positions into that stock as it develops, that is how you exponentially grow accounts. So if you can take 2 or 3 stocks, if you can take 2 or 3 trades and let them run along the stock, that will return you far more profit than taking multiple trades in a day, being in and out of positions. You'll have winners, you'll have losers. They also tend to cancel each other out. It's stressful, it's time consuming. You want to get away from that philosophy. Some other stocks that I've been in, so BA, Boeing, again, I got in at $160 earlier this year. You can see now that's over $260. Another very good stock, LRCX, Lam Research, I got in at $100. Good move to the upside. I got stopped out around $150 and then I got back in again on the breakout, and you can see now that this is around $220. Marriott Hotels. Okay, again, I got in at around $90 and it's around $130. So you can see, these are just a few examples of some of the trends that I've been in since last year and strategically open positions throughout this year. If you look at some of the UK stocks that I've taken advantage of, we've got Boohoo. We can see that Boohoo, of course, has been in some kind of correction, and there was bound to be a correction because of the move to the upside. We can't expect stocks to continuously create new highs. This has moved a lot since last year. I got in at over 60 pence. It peaked at £2.60 before starting to correct, and took my positions around, I believe it was around £2.20, around that area there. So you can see we had a good move to the upside, and then when the market started turning against us, that's when I cut my positions. Another good UK stock that I've been in, Burford Capital. Burford Capital, I believe I got in around £4, and you can see now that that is around £12. So by having a portfolio of UK and US stocks and taking advantage of this bull run that we've been in, the profit that has accumulated over the last 18 to 24 months has been significant. Far more significant than if I was focusing on just foreign exchange. Okay, now let's just look at Nvidia, for example, for now. Okay, that's the monthly time frame. So the monthly time frame, as already mentioned, gives us a very good idea of what market conditions we're dealing with. So in US stocks, very much a bull run that we're involved in. Now, where does the weekly and the daily time frame come in? Well, the weekly and the daily is where we start looking for alignment. This is where I want the weekly and the daily to be moving in the same direction. You can look at weekly as big brother, daily as little brother. If weekly is going up, I want daily to be following. So how do I do that? Very simple. I use two moving averages. I use the 200 and I use the 50 simple moving averages. I don't use exponential because I'm a long-term trend trader. I don't need the moving average to be weighted to current price action. A simple moving average all the way through works perfectly fine. Just to show you guys, so you can see visually, if you keep your eye on the 50 simple moving average, if I change that to exponential, you can see has very, very little difference. There is very little difference where it's plotted on the screen. So the simple moving average works just fine. I've got the same setup on the daily time frame. So I've got the 200, I've got the 50 and I've got the 200. So what I'm looking for in a bull market is price to be above both moving averages. So if you look at the weekly, it's above the 50 and it's above the 200. In fact, it's remained above the 50 and above the 200 going back to July of 2016, August 2016. That's when, if you just go back, you can see around this area here, you can see it peaked below it, went back above it, and then it's remained above the 50 and above the 200 since July of 2016. If you go to the daily, if I go back, this is where I entered my first position, which was $40 in May of last year. And you can see how the 50 is a proven level of support and resistance once the market is in a trend. So you can see how the 50 was held strong rather as a level of support in a bull trend. Now sometimes the 50 will get broken like it does here. Now if the 50 gets broken, what I then do is look for horizontal levels of support and resistance. Horizontal levels of support and resistance are far more significant than moving averages. So if the moving average was broken, this doesn't necessarily mean I will exit the trade. It may be part of your trading plan, and it's not wrong to exit a trade if the 50 moving average gets broken. But I tend to look at where prices are heading towards. And if you have a look, it moved towards that $100 mark. And if I just bring up a key level of support and resistance right there, so you can see that looking at where this green bar is, it came towards this level of support, which is around the $100 mark. Now remember, round numbers, these are key levels of support and resistance, but they aren't hard levels. They are zonal areas. And how do you define the zone? Well, I define the zone by looking at the round number and looking at where the pivot levels are around that round number. So we've got a clear level of resistance, which is acting as support. And we can see how on 1, 2, 3 occasions that support level was not breached. Price then bounced off it and has continued to remain above the 50 SMA. So we continue to have alignment between the weekly and the daily time frame. Remember, this is the real art of trading. The real art of trading is the exit management once you're in a trade. And it's the aspect of trading that a lot of traders find difficult, because the focus is on the money that you're accumulating and not on the process. So if you're looking at your profit column in your broker account, and let's say yesterday it was at £1,000 in profit, today it's at £800 in profit, usually that's where people panic, close their positions, take profit, only to then see the market continue in their favor, and you could have accumulated more profit. So instead of being in and out of trades like that, which is a difficult way of growing a trading account, what you want is to learn to enter and then hold your positions, but then be aware of what price is doing in relation to support and resistance, and that will then help you to manage your exits, and also it will give you ideas of where you could enter new positions, i.e. when you could compound or scale in. So if you have a look at NVIDIA, look at where NVIDIA is now. Crucially, it's above $200. We had a break of $200. We had this gap down retest of $200, and then we had a bounce up. This movement was around earnings. Then we had a little bit of a correction to fill any sort of gaps that may have appeared, and the market is now showing strength. The IT sector has been phenomenal for profit. So some of the stocks that I'm in are, for example, is NVIDIA. Another stock that's done very well for me is Micron Technology. So if you have a look at Micron Technology, look at the monthly chart. Nice bullish run to the upside, and look at the upside potential. It's been as high as $100, which is back in 2000. So what's to say that this can't go back to that high? Remember, what is technical analysis? Technical analysis is looking at the past to then understand what could happen in the future. So highs that a stock has been before are potential highs that the market could then go back to. And if that high is then breached, well, then we're in a new market where it could then go on to create highs of 150, 200, 250, 300, etc. Now, of course, people will say that would never happen. Well, all we need to do is open up the chart of Amazon, and we can see that Amazon, not only is it above $1,000, but it's made light work of $1,000, and it's now moving further up. So back when it had reached $1,000, we would have heard people say that this is topped out and this can't go any further. And there you go. The market will always prove you wrong. Instead of trying to predict the end of the market, keep on going with the market and use trailing stop losses for when the market goes against you. Another good example of this is Apple. Now, I was at a meetup group here in the UK, in London, I don't know, let's say maybe 6 months ago. It was a meetup for investors. I like to go to these meetups just to see what other people are doing. And the gentleman running the meetup group, he brought up the chart of Apple, and he asked the group, there were probably around 50 or 60 people, he asked the group how many people thought that Apple had topped out at 150, so the stock was around this level here. And I was the only one that disagreed. I said that the trend is bullish, the US stock market is in a bull run, 150 is likely to be broken, and I think this stock would move to $200. It's likely to move to $200, and that's only because of the trend being bullish, nothing else. No fundamentals involved, purely based on the fact that we are in a bull run. My bias is always in the direction of the trend. I was the only one out of a group of 50 or 60 people that thought that Apple will continue. And you can see that this is now moving towards $200. This is not magic. This isn't hocus pocus. I didn't have a crystal ball that I was looking into and I could see the future. None of that. It's simply going in the direction of the trend. Another stock. Excuse me. So let's go back to MU just so that I can show you the alignment. So we can see we've got a bullish run to the upside. On the weekly, you can see that we've got this golden cross, but look at price being above the 200, above the 50. I got into this stock when price broke above the weekly 200 based on a strategy that I've got. And this is going back to end of last year, so around October of last year. And you can see how this is now moving. Look at the trend that is now in progress. If it clears $50, then we could see this move further. If you look at the daily, above the 50, above the 200. Now, if you have a look at this base that it formed when I got in, which was somewhere over around $20. I think it was this gap up here where I first got into my first position. You can see how I allowed my position to run, how I was aware. Now, if you're not aware of this, guys, gaps can end up being key levels of support and resistance. So when there is a gap in the market, like there was here, often what we would like to see is the market continue, so add momentum, so gap and go, or if that does not materialize, then the gaps will often get filled like it did here, in which case the smart place to keep your stop loss is below the gap to allow that gap to fill. And you can see that it went into this little range bound movement, and since then, by applying a bit of patience, the trend has now continued. And look at the structure of the trend. Look how quickly it's moving. These sort of little pullbacks, this is where people panic. This is where you apply patience, you wait for the breakout, and you add a further position and you compound. So if this clears $50, this is likely to continue. So you can see this is a very, very good looking stock. Look at the upside potential that's still available within this stock. Of course, this may not happen, and in which case I have my trailing stop loss in play that will protect all the profit that I've accumulated since October of last year. But the likelihood of a trend continuation is always greater than a trend reversal. Remember the expression, the trend is your friend? This is the trend is your friend in progress, guys. You've all heard it. Everyone's heard the expression, the trend is your friend, but it's very, very badly practiced, because what most people are trying to do is predict tops and bottoms and get in at the end, pit perfect at the top and the bottom. So the end of the current trend and the start of the new trend. It's very, very difficult, and in fact, it's near impossible for us to even be able to do that on a consistent basis. Okay, so there's AMU, another stock, just so that you can see the alignment that I'm talking about. There's AMAT, Applied Materials, a stock that I've made significant profit on since last year. And if you have a look, if we compress it, it's actually cleared the all-time high. Well, excuse me, it's challenging. Let's just mark the all-time high. Okay, so we can see that it's looking to push through the all-time high. So this is where you want to apply a bit of patience. If it breaks through the all-time high, if it breaks through $60, then we're likely to see this continue. If you look at what's happening on the weekly, above the 50, above the 200, nice bullish trend in progress. And if you look at the daily, above the 50, above the 200. At the moment, we can see that we had this gap up, price filled the gap, and it's now slowly working its way back up. If it clears this high, then we are likely to see a continuation of the trend. Okay, let's have a look at a non-IT stock. So Marriott. If you have a look at Marriott, now the last time I traded Marriott was when from $40 to $80. You can see this bull run back in sort of 2013, 14, nice bull run. Then the market went through a correction. So this is where I took my profit at some point. Market went through a correction. And then when the market broke out again, this is when I got back in. And you can see now that the bull run is back in play. If you look at the weekly, above the 50, above the 200, nice trend in progress. And if you look at the daily, above the 50, above the 200, nice trend in progress. And this is a good example of how trend structures can change. If you look at this area here, you can see the pullbacks are much deeper. So this is where I entered a few positions on pullbacks. And then as soon as the market broke out, we can see that the trend structure has now changed. We've got a much faster trend in progress. Here we've got a slow trend in progress. Here we've got a much faster trend in progress. So how you trade various trends is it's really the real art to trading. This trading is sophisticated. It's simple and it's sophisticated, yet it's often the sophistication of trading is often overlooked, as trading is often portrayed as a way to quick riches. All you need to do is make 10-20 pips a day, do that consistently every day for the rest of your life, and you'll make a lot of money. That's not how it's ever been done. If you look at people like Jesse Livermore, if you read about Richard Dennis and William Eckhart and the Turtle Traders, if you read about John W. Henry, I've forgotten who wrote the book, but if you read How I Made $2 Million in the Stock Market, if you look at all of these guys that have actually generated consistent wealth, then you will know that they've achieved it by holding and compounding, as opposed to being in and out of trades on a regular basis. If you've got a large account size, then the short-term trading can work. But if you've got a small account and you're looking to grow that account, short-term trading is not the way to do that. Okay, now arguably one of the best looking trends in the stock market is CBOE. A beautiful, beautiful looking stock. So if we have a look on the monthly time frame, you can see on the monthly time frame when it broke above $70 and this high, this is where I entered my first position. And you can see since then how this has just moved in a very beautiful, nice, linear fashion. Above the 50, above the 200, nice bullish run in progress. And on the daily, look at the run. Look how clean this run is, and look how the 50 SMA has held as a level of support. Nice, clean, bullish run in progress. Above the 50, above the 200. So looking at what we are currently going through, what do I see for the rest of 2017? If you are unaware, the Christmas period can often be a very profitable period in the market. This is called the Santa Claus rally. So let me give you an example of that. This is the euro dollar. I'm just going to bring up my crosshairs just so that I can highlight it for you. Okay, so if you look at my crosshairs, if you look at this trend, this is where I traded. So we're looking at the euro dollar of the monthly time frame. You can see that this bear trend, this is where I last traded the euro dollar. It fell 3,000 pips from 1.40 to 1.10, showing you the significance of round numbers. Round numbers are incredible levels of support and resistance. They're magnets that price will gravitate towards. So that will help with helping you keep your positions open. So when price found resistance at 1.4, the next likely level was 1.3. If it cleared 1.3, 1.2. If it cleared 1.2, 1.1. If it cleared 1.1, then the figure 1. But you can see that at 1.1, the market went into rather consolidation. Now, what I wanted to highlight was the movements over December and January. So if you have a look at this area here, this red bar here, this is the month of December. This is the month of January. So you can see how the trend just continued. So don't get complacent and have that sort of, I guess, the employee mentality, which is over Christmas, shut down, take a holiday, keep your computer closed. That's exactly what you should not be doing over Christmas. What you should be doing over Christmas is having trades running from previous and then keeping those positions open and then letting them run throughout the Christmas period in case Santa Claus decides to deliver a present. And more often than not, Santa Claus will deliver. So in terms of currencies, well, I don't know. It's difficult to say. I do have a position on the Euro New Zealand dollar. So let me explain to you how I got into the Euro New Zealand dollar. We can see there's a bull run in progress. on the monthly time frame, and I want that bull run to continue and ideally hit the highs of 2.6 potentially going forward over the weeks, months, and years. It's above the 200, it's above the 50. We have this trend in progress, and on the daily, above the 50, above the 200. Now, when did I get in? I got in when price pulled back to the 50 SMA. Not only did it pull back to the 50 SMA, but it came back to a significant level of resistance, which was acting as support. So we had a cluster support level here. This pivot acting as a level of support, the 50 SMA, and then a bounce up. So you can see this bullish bar, this green bar bounced up. That was my entry point. And you can see by just allowing a bit of patience, the euro New Zealand dollar is slowly heading up. But look at where I entered. September around 1.63. It's now at 1.72. It's hardly made any distance on this. But by holding and being in this stock, I'm giving myself the best possible opportunity to take advantage of any trends by holding my positions and letting the market dictate what it wants to do. If the currency market stays as it is, I will continue to take advantage of the stocks that are in play at the moment. I've also got a position on the euro Aussie dollar. So if you have a look at the euro Aussie dollar, we have a bullish trend in progress. It's above 1.5. I would like to see this continue towards 2.1. Those are the highs that have happened in the past. Now, of course, this may not happen, but that's my long-term vision. Think of it as a business, guys. All businesses have short-term goals, medium-term goals, long-term goals. So whenever I allocate risk to a particular setup, I also have short-term goals, medium-term goals, and long-term goals. So the short-term goal is always the next round number. So where I entered, I want to see price go towards 1.6. If it clears 1.6, 1.7, if it clears 1.7, 1.8, etc. Where I entered, my long-term vision would be the next major level of support or resistance or round number, which would be 2 in this case. So you've got to have a vision to where you see price going. So going forward throughout the rest of this year, if this trend continues, I would like to see the euro Aussie dollar move towards 1.6, 1.7, 1.8, 1.92, etc., etc. Okay, if you look at the weekly, above the 200, above the 50, so we're bullish and we're having strength to the upside. And if you look at the daily, what we had was a long period of consolidation. Now, consolidations are areas where you really want to be standing aside from. I know it's tempting to go down to a lower time frame and try and pick off a few pips between multiple levels of support and resistance. You know, if you enjoy doing that and if it's working for you, then by all means continue. For me, that's a lot of work for very, very, very little profit. And that won't grow your account long term. What you want is to be standing aside from areas of consolidation. So you can see very clearly that we have an area of consolidation. This consolidation dates from May, June of this year, all the way through to November, where it eventually broke out. And when it, one thing to note, that the first breakout can often be a fake out, and this is a perfect example. So when you've got an extended period of consolidation, so I would say anything over, say, 3, 4, 5, 6 months, when you've got an extended period of consolidation, don't take the first breakout, because this can often be a fake out. And here is a perfect example. Breakout came back in. A lot of traders would have been caught out here. Traders' remorse would have kicked in. I took the next breakout here. So this is where I entered, and you can see that it hasn't really done anything. But a trend is a function of time. What I don't expect is instant gratification. What I expect is the trade to go against me first before going into a profit. Think about it. When you go into a trade, you have an entry point and a stop loss. The distance between your entry point and your stop loss is an area where you're happy for the trade to go against you. And this is an aspect of trading that I think a lot of traders tend to overlook, because they're so focused on the market just shooting in their direction. It's not what's going to happen. A trend is a function of time. If you eliminate time, you eliminate profit. How do you eliminate time? Well, having stops that are too tight. If you have stops that are too tight, you'll continuously be getting stopped out, only for then the market to move in your favor. Widen your stop loss. Okay, and then secondly, don't expect the market to just shoot in your favor. expect the market to go against you first before moving in your favor. So this moved in my favor and has since then just gone into this bit of a lull. What I want to see is this high point broken. So if this high point is broken, then I would like to see the market continue towards 1.6, 1.7, 1.8, all the way through to the major figure of 2. So again, looking at what could happen throughout the rest of this year, that really depends on if these breakouts happen. If this breakout happens above this high, then I'd like to see these trends continue. Another stock that I have a position on is the New Zealand dollar, Canadian dollar. Okay, so I entered short below 0.90, and I'd like to see this move towards 0.8, 0.7, 0.6, etc., etc. So I'd like to see this bear trend continue. So look at where I got in, guys. I got in below 0.90. I allowed this bearish move, this swing, if you like, to happen first. I'm not interested in catching this swing. What I'm interested in is this swing happening and a key level of support, in this case 0.9, being broken, and then a continuation of the bear trend. If you look at the weekly, when I entered, which was 0.90, we were below the 200, below the 50, so bearish on the weekly. And on the daily, I entered at this pullback level here. So we were below the 200, below the 50, death cross, trend in progress, pullback to a significant level of resistance, inside bar setup. So if you guys are unaware of what an inside bar is, inside bar is where the bar you want to enter on, which would usually be the current bar, is totally encapsulated by the previous bar. So that's an inside bar. An inside bar is, think of it like a spring. So if you got an inside bar at resistance, then what you want is the market to bounce off resistance. Now you can see, again, it's been slow, it's been hard work, it hasn't really been going in any particular, with any particular momentum, moves, pullbacks, but it's slowly edging its way down. So if the market breaks and closes below this pivot, that will be, excuse me, guys, that would be a perfect entry point. That'll be a perfect indication rather that the market is likely to continue heading down, and that will then offer opportunities to enter compound positions.
So here,
yes,
I hear you struggling there. Do you want to take a glass of water? There's a few questions I could
yes,
start running.
great.
If you want to take a break for a glass of water, here you have a frog in your throat.
Yes, thank you.
So,
yes, thank you. I have that.
While you're doing that, I'll just talk so you can hear the questions. So we're going back 5 or 10 minutes. Pam wanted to know about Baba. Is it going to find that it's difficult to break it? $190. Amit.
Baba. Is this a stock?
This is a stock, I think. Yeah. So maybe later we can pull it up. Oh, you've done it already.
Oh, Alibaba. Yeah. I mean, if you look at it again, we're very much in a bull run. What I want to see is if you are in this, or if you're looking to trade this, then if you're already in this, you want this to move towards 200, you want it to clear 200, and you want it to move towards 250. If you're not in this, then you'd probably want to wait until it clears 200, because 200 will act as a significant level of resistance. If that's broken, it becomes support. That would be a good entry point to then go to see then price move towards 250.
Great, thank you. How much time do you give for a stock to generate growth in profit, and how much percentage you fix in the profit? I think Amit's asking about what?
Yeah, I understand the question. I think I understand what he's asking. So first and foremost, I would never risk more than 2%. So it really depends on what strategy I'm using, but the maximum that I would allocate per trade is 2%. Breakouts, I would allocate full 2%. Pullbacks, I would reduce it to 1% or 0.5%. In terms of how long I would give a stock to return a profit, that's really down to the market. Once I'm in the stock, I allow the market to then dictate what to do. So I could be holding a stock in positive, negative for quite a long time. But so let me give you an example of that. If you look at AMAT, I first entered AMAT on this breakout here, this gap up above $30. This is August of last year. Now, August is a summer month. So generally what tends to happen over the summer months is that the markets go quiet because everyone's on holiday. So you can see that when I got triggered in, the market went into consolidation. So I held my position. I didn't exit it. You can exit if that's your trading plan. You know, you could give it 1 month, 2 months, whatever. And if it doesn't return you a profit, you can cut out. It's not what I do. I simply hold my position. And you can see by being patient, it then went on to trend very, very well. This is where I then got stopped out. I waited through this consolidation. And then once it broke out of consolidation, I then went back in again. So I've now been in this stock since the end of September. So to answer your question, that really depends A, on your trading plan, but B, I tend to let the market dictate how to react once I've been triggered in.
Okay, thank you. What about taking an option on any of these stocks? Do you actually buy the shares, or do you buy the options?
So I do a combination of spread betting and buying the physical shares. So it depends on my portfolio.
Okay. What if you're trading an instrument that has a 50-day moving average above a 200 moving average, and it has a daily close below the 200? Would Zaheer go long or short? Okay, sorry. Did you get that? If you're trading,
okay, I think this is a really good example of where people complicate trading and try to make it more complicated than it needs to be. The best techniques in trading are simple. I use the 200 simple moving average as a bias. So if it's closing above, I'm looking to go long. If it's closing below, I'm looking to go short. The 200 simple moving average was used by old school traders to be able to give them a bias to price. Institutions still use that logic today. So I try to keep it as simple as possible. If it's above the 200 and the 50, I look to go long. If it's below the 200 and below the 50, I look to go short.
There we are. Simple as. Where do you keep adding the position? How much and where does the stop go? So when do you decide to add to position? If indeed you do add to position, where do you place your stops?
Yeah, so first and foremost, I will only add to winning positions. So I know a lot of people add to losing positions, but I think that's a very dangerous game because often people don't know the difference between a pullback and whether the market is reversing. So if you keep on adding to losing positions, thinking that the market's eventually going to bounce in your favor, then you could end up with a blown trading account, which I think many people have faced at some point. So I would first of all only add to winning positions. How you would do that, well, that really depends on what kind of trend you're dealing with. So are you dealing with a fast moving trend, or are you dealing with a slow moving trend? If you're dealing with a slow moving trend, you may only want to compound on the pullbacks. So let's have a look at MU, for example. If you look at MU, if you look at from this point here to this point here, the pullbacks are quite significant, in which case you could compound on the pullbacks. Whereas at this point here, the market's moving very quickly, in which case you would really only want to compound on the breakouts. So it depends on what the market is dictating. It's not something that I try to guess. I keep it simple. I look at the market structure I'm dealing with, and I understand whether it's a fast moving wave or a slow moving wave. If it's fast moving, I trade the breakouts. If it's slow moving, I trade the pullbacks.
Okay, so we have got just over 10 minutes left in our hour. Do you need to go through more presentation, or are you happy to keep taking questions?
Well, I'm happy to. I mean, that's the bulk of how I trade. If you understood what I've done, then you've understood how I break down a chart. So, I'm happy to take any questions.
Okay, fantastic. Well, let's carry on with there's a lot of questions coming in. What about volume? Do you take volume into?
Yeah, really good question. Really good question. So right-click, edit chart. So yeah, I definitely look at volume. So I like to look for stocks that have volume over 1 million. Again, as mentioned earlier, I try to stack the odds as much as possible in my favor. If you stocks that have volume over 1 million just gives me that added confidence of a trend continuation. And I have an average. The black line is a moving average of 50 days. So I want to see the average volume increasing. I want to see breakouts on greater than average volume. Yeah, definitely. When it comes to stock trading, volume is important.
Fantastic. Let's moving down. What about scanning for stocks? Do you use anything for scanning? Any tools?
Definitely. I mean, you've got 500 stocks in the S&P alone. You start going through all the other groups. The indices, the Dow, the Nasdaq. It all just starts adding up. And who has time to go through hundreds, if not thousands, of stocks on a daily basis? You need to have good tools for the job. What you're seeing here is just basic technical analysis, but to get to this point, there's a lot of work that goes into it. So I have software, I have scanners. I use 2 bits of software. I use eSignal and I use Metastock. Both have their advantages. eSignal, the charting is very good. Metastock, the scanning that it can do is pretty phenomenal. But I've invested. It's not expensive. Metastock, $100 odd a month. eSignal, around the same price. It's worth investing in good tools because it then makes everything far easier, and the returns and the rewards you are then given based on good investment is exponential.
Thank you. Okay, Pam saying when the price breaks the 200-day moving average, there could be a real break versus a false break. Is there a way to tell the difference and trade correctly?
Yeah, I mean, of course, you can't guarantee getting caught up in a fake breakout, which is why you always want to have a small risk. This is essential. Trading is all about random statistics. This is something that people must embrace, the random outcome of any trade, which is why when your edge presents itself, however you define your edge, you must take the trade. You can't then not take a trade when your edge presents itself. So let's say I have 5 trades, each where I'm risking 2%. And out of those 5 trades, let's say 2 of them end up being losing trades. So all 5 of these trades meet my edge. 2 of them end up being losing trades. So that's 4% that I'm down. 1 of them doesn't make me any money, doesn't lose me any money. So I get stopped out at risk-free or break-even, however you want to define it. So that's 0%. So I'm still 4% down. Now, the remaining 2 trades, let's say they all go, let's say over the next 6 months, they return me 20% each. So that's 40% minus the 4%, that's 36% return that I've made. Now, I've made that not based on understanding which one of these trades are going to make me money, just simply taking the edge and then letting my winning trades run. So going back to answer the question, you can't protect yourself from fake outs 100%, but you can reduce the chances. I've already explained how to do that. First and foremost, don't take the first breakout. If the 200 moving average, let's say, gets broken, you may not want to take that first breakout. Wait for a break. Then often what happens is a retest and then the next breakout. When that retest is happening, that retest could then be the fake out where the market comes back below. Instead, wait for the bounce, the breakout, and then look to get in. So yeah, apply patience, first of all. And secondly, always risk small so that if it's a losing trade, it's insignificant. 0.5%, 1%, maximum 2%. These are insignificant losses, but the upside potential is huge.
What about Fibonacci? Any use of Fibonacci extensions?
I think Fibonacci I think Fibonacci can be useful. I find Fibonacci retracement more useful than Fibonacci extension. The reason for that is because I use the round numbers for target level. So for me to then get the Fibonacci tool, click on the points, it's just work. I want to be able to do as little as possible. I don't want to be spending hours of my time doing analysis. It then becomes a case of analysis paralysis. I'm a trader. That means I do the what I need to do in terms of the analysis, but I then want to be able to understand where to put my entry points, my stop losses, and then once I'm in a good trade, to allow them to run. I don't actually need Fibonacci's to tell me that. Price and support and resistance and moving averages tell me everything that I need to know.
Okay, Pam says thank you for the full answer that you gave to the previous question on the breakouts.
You're welcome.
Okay, so does Zaheer trail stocks and FX? Do you do any FX trading at all?
Yeah, I mean, I just went through examples, right? Euro, Aussie dollar, Euro, New Zealand dollar, Euro, yen. Okay, let me put it this way, guys. If I hid the fact that this is Micron technology, if I hid the name and I presented you with a chart, you have to be able to know whether that chart is tradable based on what you can see. The fact that it's a currency or a stock or a commodity should not really be the main reason as to why you're trading. It's what you can see in front of you. It's the chart that how that chart looks should determine whether you're going to place a trade or not. So I trade everything. I trade foreign exchange, I trade stocks, I trade commodities. But out of that, I will go to where the money is. And the money is where the trends are. And foreign exchange has been flat for a very long time.
Fantastic. So here we've got just another 3 or 4 minutes. I'd like to tell everybody where they can get in touch with you afterwards, if these questions might go on. So
yes,
where would people go if they did want to continue a dialogue with you?
Yeah, I would say that as you mentioned at the beginning, I've recently, after a conversation with Peter Reed and Peter Watson, they have asked me to open up my own room on the Pelican app, and I've agreed to do that. The first month is free, so if you use this code, which is Z8H334, join the group, and we can start communicating through there. If you want to email me, you can email me on my name, which is just Zaheer at zaheeranwari.com. It's quite a new group. I do have the Euro Aussie, the Euro Kiwi, and the Euro Yen, the 3 trades that I mentioned in foreign exchange. I do have them open. The Euro New Zealand dollar is in a bit of profit. The Euro Aussie and the Euro Yen are in negative. It's early days. It's an environment where I'm hoping that people who have tried the short-term approach, who are short of time, who have a family, and have been struggling to get trading adapted around their day-to-day lifestyle, this is the group that you want to be in. It's not going to be exciting. It's not going to be high-paced. It's going to be slow. It's going to be steady. But if you give this time, guys, it's going to be highly, highly rewarding, both in terms of the profit that can be accumulated, but more importantly, if you really think about it, it's time that we want. We want time to spend with our family and friends. We want time to do things that we enjoy, but without having to compromise on money. If we want more time, we compromise on money. If we want more money, we compromise on time. That's where trend trading comes in. It eventually gets you to a point where you no longer have to compromise. So, I would say, please get involved, guys. It's free for the first month. You've got nothing to lose. Just jump on board and let's get a dialogue and conversation going.
That sounds great. So here, given that it's a month, given that you're a slightly longer term trader, you may not be placing trades every day. Is that
correct? Do
you anticipate a sort of an average amount of trades that you might expect to do every week, or?
See, no, this is exactly what won't be happening. What I want people to understand is that look at all the quotes that we know, all the famous quotes that get thrown around trading. Trade well, not often. It's a famous quote. Let your winners run, cut your losers short. let the trade come to you. You know, all of these famous quotes and expressions. You know, Warren Buffett. One of my favorite quotes by Warren Buffett. I know he's an investor, but the point is that Warren Buffett said that something along the lines of it hardly rains in trading, but when it does, it rains gold. You know, it's that kind of mentality where, you know, you may have to wait, be patient, but then when the market does kick off, you know, the amount of profit that can be accumulated in 1, 2, or 3 months is phenomenal. So the mindset of the way we approach the market, the way we place our trades, the analysis that's done, it's very, very different. But as private traders, this is the approach that you want to be taking.